Fortis has raised its dividend every single year for 52 consecutive years. As of the company's Q1 2026 results, presented May 6, 2026, this dividend growth track record is explicitly described as now spanning 52 consecutive years, one of the longest active dividend increase streaks of any publicly traded company in North America. Full stop, not just within the utility sector. A streak that long invites an obvious question. What is actually behind it? And is it as unconditionally reassuring as the headline number makes it sound? This video is the complete, dedicated breakdown of Fortis, what the company actually is, the specific reason analysts describe its free cash flow as structurally negative, without that being the warning sign it sounds like, the $28.8 billion capital plan driving the company's forward growth, the genuine leverage-related risk worth understanding, and exactly how a Canadian investor should think about this stock for tax purposes. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. What Fortis is, structurally, Fortis is a diversified holding company, running a portfolio of separately regulated electric and gas utility operations across Canada, the United States, and the Caribbean, described by independent coverage as built on stability through a diversified group of fully regulated electric and gas utilities, with management specifically emphasizing safety, reliability, and long-term planning as the foundational pillars of the business. Why regulated is the single most important word in that description. A regulated utility does not set its own prices or earn whatever the open market happens to allow. A government-appointed regulatory body in each specific jurisdiction approves the utility's allowed rate of return on its invested capital, called its rate base, and approves rate increases needed to recover the cost of new infrastructure investment. This is fundamentally different from a company competing for customers on an open market. It is closer to a negotiated long-term partnership with each specific regulator, which is precisely why independent coverage describes Fortis's earnings as benefiting from this kind of predictable structure. The financial scale, current as of Q1 2026, Fortis reported net earnings of 501 million Canadian dollars, or 99 Canadian cents per share, for the first quarter of 2026. A modest increase in absolute earnings, though a 1-cent decline in per-share earnings compared to the prior year quarter, attributed by the company's own presentation to foreign exchange fluctuations and the effect of prior asset dispositions reducing the earnings base. A big part of that minor 1-cent per-share dip is actually a side effect of their own success, an increase in the total number of common shares outstanding, driven heavily by retail investors participating in the highly popular Fortis Dividend Reinvestment Plan, or DRIP. The stock closed at $78.33 following that presentation, later trading around $77.28, near its 52-week high of $80.69. Credit quality, an important but easily overlooked signal. In May 2026, the independent credit rating agency Morningstar DBRS confirmed Fortis's A-low issuer and senior unsecured debt credit ratings, with a stable outlook, a meaningful, independent third-party signal of the company's financial reliability that sits separate from, and adds credibility to, the company's own self-reported figures covered throughout the rest of this video. Your action step. Before evaluating any utility stock's earnings stability, identify specifically which regulator or regulators govern its rate base and allowed return, because this regulatory relationship, more than almost any other single factor, predicts how predictable that company's future earnings stream will actually be. Here is the vault from the opening. The specific reason analysts repeatedly describe Fortis as having structurally negative free cash flow, and why that phrase, while accurate, is not the alarming signal it would be for most other types of companies. The sourced language itself, stated plainly across multiple independent providers, simply Wall Street's own coverage states directly, Dividend is covered by earnings, 73% earnings payout ratio, but the company has no free cash flows available, indicating it may be using cash reserves or debt to pay the dividend. TipRanks independently flags the identical pattern as a named risk factor. Structurally negative free cash flow. Persistent negative free cash flow and weak earnings to cash conversion mean the company relies on external funding for CapEx and distributions. Why this happens and why it is a designed feature rather than a malfunction, a regulated utility's entire growth model, covered in Segment 1, depends on continuously building new infrastructure. New transmission lines, substations, pipeline replacements, which the regulator then allows the company to earn a return on once that infrastructure is placed into service. This means a growing, regulated utility is, by the very design of its business model, almost always spending more in capital expenditures in any given year than its current operations generate in cash, because it is continuously reinvesting in a larger rate base for future earnings. To pull this off smoothly without over-leveraging, management uses a highly calculated funding mix for this massive capital allocation. 59% is funded by internal cash generated from core operations. 30% comes from net debt issuance, and 11% is funded by common equity, largely fueled by that automated DRIP program we just mentioned. Exactly what TipRanks' own risk language describes as relies on external funding for CapEx and distributions. The earnings-based payout ratio, the more directly relevant measure here specifically, Fortis's payout ratio measured against earnings specifically, not cash flow, sits at approximately 73% to 74%, with Simply Wall Street describing this directly as a comfortable 74%, even while flagging the cash flow point in the same breath. This is an important pattern to notice in pipeline and utility analysis generally. A net income or earnings-based payout ratio is not automatically the misleading figure, and cash flow is not automatically the more reassuring one. Which specific measure tells the more accurate story depends on the specific company's accounting structure. And here, the earnings-based payout ratio is the more reassuring figure, while the cash flow picture is the one requiring the additional context this segment provides. Why this is genuinely different from a company burning cash to survive? The distinction that matters is why the cash flow is negative. A company with negative free cash flow because its core operations are unprofitable is in a fundamentally different, more precarious position than a company with negative free cash flow, specifically because it is continuously investing in new, regulator-approved infrastructure that is expected to generate growing earnings for years afterward. Exactly the distinction TIKR's own coverage draws when describing Fortis's structure as producing predictable earnings, specifically because of, not despite, this ongoing reinvestment pattern. The honest, complete caveat: this explanation does not make the underlying fact disappear. Fortis genuinely does rely on continued access to debt and equity markets to fund both its growth and, to some degree, its dividend. And any disruption to that access, a credit rating downgrade, a sustained spike in borrowing costs, a regulatory setback, would represent a real structural vulnerability specific to this financing model, covered directly in Segment 4. Your action step: Whenever you see negative free cash flow flagged for a regulated utility, REIT, or similar capital-intensive business, ask the specific follow-up question this segment just answered for Fortis. Is the cash being spent on growth-generating, regulator-approved infrastructure, or is it covering ordinary operating shortfalls? Because the two situations carry meaningfully different implications despite producing an identical-looking negative number. The headline, Capital Plan, sourced directly from the company's own Q1 2026 SEC filing. Fortis's $28.8 billion five-year capital plan is expected to increase mid-year rate base from $42.4 billion in 2025 to $57.9 billion by 2030. The company's own release states, translating into a five-year compound annual growth rate of 7%. This represents a meaningful step up from the company's prior five-year plan, which had targeted approximately $22.3 billion in capital spending at a 6.2% compound annual growth rate. An approximately $6.5 billion increase in committed capital deployment, alongside an upward revision in the targeted growth rate itself. Why this specific number is the engine behind everything else in this video. As established in Segment 1, a regulator approves a return on rate base, meaning a larger rate base, all else equal, produces larger regulator-approved earnings over time. The company's own forward language is direct about this link. Fortis expects its long-term growth in rate base will drive earnings that support dividend growth guidance of 4 to 6% annually through 2030. This is the specific mechanism connecting the capital spending covered in this segment to the dividend growth that extends the 52-year streak from the hook. The composition of the spending, mostly small, low-risk projects, independent analysis specifically notes that of the company's annual capital spending of approximately $4.4 billion, 83% is smaller projects, with the same source assessing that, in accordance with the company's capitalization and debt, this is highly executable, meaning the bulk of this enormous capital program is not a small number of large, high-risk mega-projects vulnerable to cost overruns and delays, but a large number of smaller, individually lower-risk investments spread across the company's various regulated jurisdictions. But don't let the phrase "smaller projects" fool you into thinking there's no explosive growth potential here. Fortis is quietly positioning itself as a vital layer for the massive data center and artificial intelligence boom. In fact, in March 2026, their subsidiary ITC achieved a major milestone by officially completing a new substation at the Big Cedar Industrial Center, specifically designed to support 300 megawatts of rapid load growth for its first major data center customer. Geographically, ITC's U.S. transmission grid modernization is the absolute crown jewel of this layout, capturing roughly 46% of that total $28.8 billion spending budget. The remaining growth is balanced out by heavy electrification and infrastructure priorities at UNS Energy in Arizona and Fortis BC right here in British Columbia. Recent financing activity, demonstrating the market access dependency from Segment 2 in action. Fortis raised $800 million in long-term debt during Q1 2026, with its subsidiary ITC Holdings issuing $500 million in five-year notes at 4.88% and $400 million in 10-year notes at 5.50% in April 2026. A direct, current, real-world illustration of the company accessing debt markets specifically to fund the capital plan covered in this segment, exactly as the Segment 2 discussion predicted. The historical performance context, why this approach has compounded well over time. Independent commentary notes Fortis's 10-year average compound annual growth rate of around 11.3%, compared to 8.8% from the S&P over the same period, and roughly 100 basis points better than its closest utility peers. With the same source noting the company never lags peers and only lags the market in the short 3-year term. A useful, honest acknowledgement that this specific defensive, regulated business model has, over the longer run cited, actually outperformed the broader market historically, even while underperforming over shorter, more recent stretches. Your action step: when evaluating any utility's growth story, check specifically what proportion of its capital plan consists of large, singular mega projects versus many smaller, individually lower-risk investments, exactly as independent coverage did for Fortis's 83% small project composition. Because this composition meaningfully affects how much execution risk sits behind a given headline growth percentage. The genuine risk, named directly by independent coverage, tip ranks specifically flags elevated leverage relative to equity as a named risk factor for Fortis, stating directly, high debt relative to equity limits, financial flexibility, and increases refinancing and interest rate sensitivity. This is the natural consequence of the Segment 2 and Segment 3 financing model. A company continuously raising debt to fund a multi-billion-dollar capital plan accumulates a meaningfully larger debt load over time, even while that debt is being deployed into earning regulator-approved assets rather than being consumed by losses. Why this risk is real, not merely theoretical, given the current rate environment. The same financing activity covered in Segment 3, borrowing at 4.88% and 5.50% on the company's most recent notes, illustrates directly that Fortis's borrowing costs are not historically trivial, and the company's own stated reliance on continued debt issuances to fund both growth and, per Segment 2's analysis, a portion of its dividend, means a sustained period of meaningfully higher borrowing costs would directly pressure the earnings growth this entire video has covered. Why the credit rating from Segment 1 is the specific mitigating context here. Morningstar DBRS's A low rating with a stable outlook, covered in Segment 1, is the market's own independent assessment that this leverage, while elevated, remains within a range the company can service reliably given its predictable regulated cash flows. A rating that would be the first, most visible indicator to watch for any deterioration in this specific risk picture going forward. The Canadian Tax and Account Application. Fortis trades on both the TSX and NYSE, and as a Canadian corporation, its dividends qualify for the eligible dividend tax credit when held in a non-registered account, distinguishing it from the U.S. withholding tax considerations that apply specifically to U.S. domiciled companies, not to a Canadian company like Fortis. Held inside a TFSA specifically, Fortis's distributions are entirely tax-free regardless of this mechanism. Your action step. If you are evaluating Fortis specifically, check its current credit rating and outlook directly with a rating agency or financial data provider before treating the comfortable payout ratio framing from Segment 2 as the complete risk picture. The credit rating specifically incorporates the leverage concern this segment has covered, providing a single, independently verified signal that synthesizes much of what this entire video has walked through individually. Let's come back to where we started. Fortis has raised its dividend for 52 consecutive years, one of the longest active streaks of any publicly traded company in North America. You now understand the complete sourced mechanism behind that streak and the honest tension sitting alongside it. Fortis's earnings-based payout ratio is genuinely comfortable, at roughly 73% to 74%, while its free cash flow is structurally negative, not because the underlying business is struggling, but because a growing, regulated utility is, by the very design of its business model, supposed to continuously reinvest in new infrastructure faster than its current operations generate cash, funded by a combination of retained earnings and ongoing access to debt and equity markets. That reinvestment is directly feeding into massive megatrends like grid modernization and AI data centers, funded by a combination of retained earnings and ongoing access to debt and equity markets. That access is currently confirmed by an independent A-low credit rating with a stable outlook, and is currently funding a $28.8 billion five-year capital plan expected to grow the company's rate base by 7% annually, directly supporting management's own guidance of 4 to 6% annual dividend growth through 2030. The genuine risk worth watching is not the payout ratio at all. It is the elevated leverage this entire financing model produces, and specifically, any future deterioration in that credit rating or any sustained spike in the borrowing costs the company depends on to keep this entire growth engine running.